Ladies, gentlemen, crypto degenerates, welcome to this podcasty type of special kind of episode. We're doing this for Crypto HQ. I'm sure you guys have seen some of the other videos and content that everyone else is putting out so far. And we are doing something similar. We're in the same vein. We're doing crypto content for you guys. Today, I am joined by my friend, the Grand Nagus. So you guys have probably seen him before if you've watched the Raven interview or the Dusk interview. So, Nagus, say hello.
Indeed. Hello. Hello. First time on this channel.
Yep.
Hopefully it'll be interesting. People will enjoy it.
Yep.
I'll do my best.
So we're going to talk about topics that we think are generally not very much discussed when it comes to crypto, particularly because it takes a lot of technical know-how and a lot of experience.
Well, they are discussed, but not really in much depth.
Right, exactly. There's not much breadth and not much depth to it. So we thought, why not go into the real meat and potatoes of it? So this episode is going to be one that we talk about just the general... Not so much regulations. I think regulations will probably be part 2. But this one will be talking about the general ecosystem of crypto and what has happened historically, recently, and moving forward, and all of those fun things. So this is going to be a very general video. I think this is going to be quite useful for people who maybe have not been following Bitcoin, have not been following crypto as of late. Understandably so, given the shitty market performance of pretty much every altcoin across the board, as well as Bitcoin. So yeah, that's basically what we're going to talk about. We're going to have a little bit of a discussion. And yeah, if you guys enjoy this stuff, we can definitely do more of this. We'll probably have this as like a 3 or 4 part video eventually, where you can just watch the episodes. But yeah, let us know if you guys enjoy this kind of content. Let us know in the comments, like the video, do all that fun stuff, retweet. And yeah, let us know if this stuff was educational. So, Nagus, let's begin.
Okay, I thought we were going to intro on something. The recent event, obviously, that occurred this week was Bakkt. Everybody's excited about it. Ooh, it will bring retail money. Ooh, it will bring institutional money. I've never been convinced it will do anything of the sort, quite frankly. It is not the second coming. It will not generate the pump, nor will anything else of this nature. Periodic, yeah, but not sustained. And to understand the reasons behind that, you have to understand what a beast like Bakkt or an ETF or a paper derivative actually is, and the nature of the people who operate them, the nature of the entities they work for, etc. And, historically, what their behavior has been in other markets with structures like this. And everybody just seems to talk about the impact on crypto rather than talking about, well, what I'm really saying is talking about the context and the history of these kind of structures. Do you see my point?
Right.
It's what will it do for crypto rather than what these things actually are, and based on their history, what they are likely to do. The contextual history, as it were. Bakkt, let's say, is a contract-driven trading platform where trades are settled, unlike ETFs, pure paper trades, in the actual asset. Now, that being the case, there is presumably if two parties execute a trade on the exchange, let's say it's a large one, what happens if the party on the losing side, because this is, it's a buy-sell game, it is presumably a zero-sum game, as we all know. If the Bakkt mandates that trades are settled in Bitcoin, what happens if the party on the losing side who wants to settle in cash can't settle in Bitcoin? In terms of the rules, that should not occur. However, push comes to shove, Bakkt still has to, wouldn't you say, recover its loss and resolve the contract. So I would imagine, though it's not been advertised, that there is a mechanism that, should that occur, that would allow the party to settle in fiat or another asset. wouldn't you say?
It's actually...
That's a safeguard. Otherwise, it has to be there. Corporations protect themselves.
It's interesting to say that, because I was just having this discussion with Loomdart and a few other people about this. So there's very little...
What happens if they've been doing something, they stake that coin, they've been doing something on another exchange with that coin, and it's locked, and they're like, oh, bloody hell, shit, will you take cash? You see my point?
Yeah, so there's actually not that much information available publicly on how Bakkt mechanically works, but I did manage to get a little bit of data. So when they say physically backed, they mean physically backed as in, even if you're short, you still have to trade with the Bitcoin. So how that works is, if you're long Bitcoin, you can buy with fiat, and then they cash you out in 24 hours. The next day you receive your Bitcoin. So it's a good way for people to onboard. It's a good way for people to go long. If you are short, the way that it works is, you have to buy Bitcoin somewhere. You have to have it in a wallet. Then you have to load it onto Bakkt. And once you're on Bakkt, you can short that Bitcoin that you just bought. So it's extremely inefficient. It's one of those things where...
Exactly.
Yeah, it's one of those things where it doesn't make sense for... It's good. Bakkt is good if you're going long. It doesn't really make sense if you're going short. If you're going
shorting was what I was getting at.
Yeah, if you're going short, you don't really care even about the physical underlying. All you really care about is there a liquidity? Can I enter and exit this? And if you're short, you don't really even care about taking even the risk of handling Bitcoin for that, let's say, 2 or 3 hours while you're transferring it over to Bakkt. The better way to short it, if you're institutional money, is you use the other institutional tools, primarily SIBO and CME, which are the paper derivatives, which have existed.
Yeah, papers are much better for that. If that's what you seek to achieve, this is not efficient for them. I don't think it will drag in retail, because it's still not really an efficient way of doing things for retail investors. You have to remember that we're all early adopters. Yeah.
Right.
People have clued themselves up with the technology through trial and error, and they've learned how to use wallets and transfer and use keys and everything else, and go through, the rigorous KYCs and God knows what else they've built in. I haven't actually looked at it myself, I'll admit. All I've been doing is reading the presses and the spec and the articles about it. But for individuals, it's not friendly. For large funds, maybe, but they're not going to go long. They're going to want to go paper trade, which they've been doing. Right. So it won't drag in large amounts of retail money. That's a complete myth. It won't. Well, this iteration won't, yeah? Maybe in the future when it's friendlier and easier to use, maybe. But that beast will basically arrive on the scene for another year or two.
Yeah, I don't think...
So hoping for it now is pointless.
I don't think Bakkt is a custodial solution either. So what that means...
No, it's not.
Is that people had the impression that Bakkt is going to make it easier for retail traders or institutional traders to buy Bitcoin.
No.
The thing is in 24 hours, you receive your Bitcoin. So that means you need to have a wallet set up. If you need to have a wallet set up, you need to know how to use Bitcoin and how to use wallets and how to... So because it's not a custodial solution, you already need to learn all of the other things that you wanted to avoid in the first place as an institutional or retail trader.
Yeah, it's just a regular exchange in that way, just with exactly. Bakkt branding, with the NASDAQ label behind.
Yeah.
Where's the sizzle?
Right.
I don't see anything there.
So, yeah, it has to be a custodial solution, kind of like how, what's the one, Grayscale, right? So if you're buying some Grayscale investment trust, even if you're paying 2 or 3 or 4 times premium, whatever it is now for an Ethereum token, they are holding it onto it for you, so you don't have to get an Ethereum address. You don't have to care about how addresses work and how sending works and transactions and all this stuff. That's something that would be much more compelling for a retail trader and institutional money, and especially the narrative of people who are saying, oh, it's going to be so much easier for retail traders to buy in. It's like, not really. It's the same amount of complexity. Actually, it's even more because there's extra steps of getting onto Bakkt.
Yeah.
Yeah.
So it's hot air, which when, we had such a crappy dip this week, when it did actually launch, it doesn't really surprise, because even if there was going to be a pump on launch, it's been bandied around the airways for so long, and there's been so many, Bakkt is coming, it's coming then, they're testing now, whatever, that any gain is already priced in.
Mm-hmm.
It's already priced in before the launch, so how are you going to get a pump on the day?
Yeah. So
historically, buy the rumor, sell the news. It applies with the launch of a platform as well.
Yeah, the way that I had actually thought about this and figured this out was there was that news article before about 2 or 3 weeks and in the beginning of September that said Bakkt soft launch. So you can now get onto Bakkt and load your account or whatever. I don't remember exactly what it was, but it was Bakkt soft launch was the title, the headline. And
yeah, that was
when that article went out, if you look at the Bitcoin price, it dumped. So it didn't do a mega dump because it was obviously the news was people were unsure exactly what soft launch meant. And then later we learned it was not a real launch, obviously. But
it was kind of it was a precursor.
Right. That's the way that I looked at it. I said, oh.
Yeah.
So this means that when Bakkt actually comes out, everyone's just going to dump it then. Because that's what people were doing at this time. Yeah.
Yeah. Yeah. So it doesn't have the friendliness for retail at this point, so it's not going to really do anything there. So I think pretty much we can dismiss it, in terms of what it's going to do to price, because what it's done. I don't really see Bakkt on its own driving the entire price down lower.
Yeah.
It can't do that.
I would say...
It doesn't have the volume, doesn't have the users yet.
Yeah, I would say if... The best way to do this, and I mentioned this in a different podcast, and I should have done this, but I didn't have so much time, is what you actually want to look at. Let's say you are an institutional investor and you want to short the shit out of Bitcoin, and you want to do it when coinciding with this Bakkt release because you know it's going to dump. What you actually do is you do it on CME. So the way that you actually check for this is you go on CME and you check the volumes right now. You see, what are the CME volumes doing? What is it all-time highs? Is it stagnating? Because if you look at the Bitcoin markets, BitMEX, and all these other places where Bitcoin is traded, it was very low volume because everyone was waiting for the news. If the story is that we go on CME, and I haven't confirmed this, so anyone who's listening can check this for themselves. Go on CME, check the volumes. If the CME volumes were high, then that means that there was a lot of interest in shorting as opposed to traditional crypto traders who had no interest in this until the triangle resolved, until the news resolved. If the CME volume is low, then that means institutional investors also agree with crypto traders that this is not a level that you want to be shorting, and it's also not a level that you want to be longing either. It's kind of undecided.
Yeah,
so that's
keep your
that's
powder
the
dry.
big,
Yeah.
So it's one of two cases. It's either neutral or it's negative. I don't really see a massively positive upward thrust because of Bakkt specifically.
Yeah, I think it was basically a marketing push more than anything else. It's not going to do anything in the near future. Which kind of brings me on to talking about paper trading platforms and derivatives, ETFs, etc. If you want to understand how those work beyond the mechanics, I think you have to look at the history of these, the history of trading paper contracts way before crypto, and the nature of how they actually worked, and historically what they did in terms of price. And if you look at things like paper trading in commodities, for example, oil and gold and anything else you'd care to name, historically they have been used on both sides of the fence, buy and sell, as mechanisms of price manipulation at volume for decades now, especially oil and gold, because you're not settling in the physical asset and it's a pure speculation based on contract prices. Peter Schiff, I don't particularly have a lot of time for him, but when he talks about gold being suppressed through paper contracts, he is correct. That has been true. for a long time, even though it's starting to break out now. The same thing has happened with oil prices. Oil prices are, to a point, manipulated by demand and supply and demand, but also they're suppressed through paper contracts because, certain economies have an interest in controlling the price of certain commodities to benefit their fiat markets or their trade policies or their geopolitical policies. And this has been going on since World War II. And historically, this has always happened. You have numerous occasions. I mean, this happens in LIBOR and Forex as well, as we know, where people have been caught, people have been fined. But have you ever noticed something really interesting about this, which I noticed a long time ago, is that when they're caught, we hear about it, yeah? Mm-hmm. But when nobody's caught, you don't hear anything about it. And nobody goes to jail either. Now, these are large corporations and banks and trading desks and whatever. In the LIBOR case in London, you had a situation where a guy at one LIBOR desk, was going drinking with 3 or 4 guys at other LIBOR desks. And they were basically arranging price pumps and dumps between them, timed ones. They were even calling each other's desks at the time to basically place contract, bi-directional bets or to push things down and then buy up at the same time, which is collusion.
Right.
That is fraudulent trading. Now, this has been going on for decades. Yeah, nobody goes to jail. Nobody gets caught. And you can say, what makes people think in terms of ETFs and derivatives platform that crypto is going to be any different? Look at the people doing this, at volume. Look at them. Because they all have one thing in common. And this is a historical, I'm an old bugger, sorry. I trained as a historian. They work for corporations. Now, people talk a lot about that kind of corporate mentality now, but you have to understand what a corporation actually is and what its obligations are. Now, starting in the 19th century in the States mainly, when an organization was incorporated, regardless of its statements about being good to its employees or the environment or don't be evil, like Google, for example, recently, those are slogans, yeah? Those are fig leaves, as it were. In the Articles of Incorporation, the only obligation, the only purpose, binding, purpose that drives a corporation is maximizing shareholder profit. That's it, yeah? Nothing else. There are no environmental obligations, no obligations to society, repaying your taxes, nothing to treating employees fairly, nothing to, more importantly, there are no obligations a corporation will behave ethically, or within the law. That isn't even in the Articles of Incorporation for any incorporation. They have no incentive or no restriction, nothing that tells them internally as an organization they must not break the law. So, since that is a given in the Articles of Incorporation of any bank or multinational or trading house or whatever, it stands to reason that they propagate this culture to everybody working for them at the sharp end who's handling money, yeah? Mm-hmm. So then you have a culture and a mentality that maximizes personal gain as well as the bottom line in terms of profit, dividend, etc. for shareholders and nothing else. In other words, this is a completely amoral environment. There is no ethical imperative whatsoever, yeah? It is the Wild West, regardless of all the rules and regulations. You see this happening how many times have JP Morgan been caught? Is it over 160 times now? You have Chase, you have HSBC laundering money for the cartels.
Every few weeks.
You have Deutsche Bank, you have, what is it, the M1B thing? I can't remember the name of it now. That one. You have BCCI, this has gone on for decades, if not 100 years. Now, do you really think these people, and it is the same people, yeah, with the same mentality, and when all that happens is a fine, and that is all that ever happens. Nobody ever goes to jail apart from, say, one case in 50 years, Nick Leeson or something, yeah, at BCCI. Then a fine just becomes a tax on doing business, doesn't it?
Yep.
That's all it is. It doesn't prevent people from doing them. It doesn't deter people from doing any kind of market manipulation or wash trading or anything else. It doesn't. And they will continue to do. And what you will have, and I think what we have had since CME and CBOE launched, is there have been massive price swings at volume. And if you look at the nature of the spikes and the way they can contrive to drive an asset down over time, normally in big dives, we've seen it amplified in crypto since last year. This is a repeat pattern. This is something that... there's no regulation in this market, really, because, shocking though it might be to hear, things like wash trading, things like excessive arbitrage due to vast disparities in spot pricing, insider trading even, and collusion, have only been illegal since 1929. Before that, it was commonplace. Read Edwin Lefebvre's Reminiscences of a Stock Operator, how the guy got started. He'd place an order for one thing at one desk and then go to another house of trading, on the ticker, another desk, say 10 miles away, and the price would be radically different, and he'd collect there as well. Mm-hmm. That was common. That was the price of doing business. Nobody batted an eyelid at it. It was only when it got embarrassing that legislation was actually made. But that doesn't stop it happening, because, as I said before, we only ever hear about this when people get caught. That doesn't mean it stops. And I think that's what's happening here too. That's what large institutions and banks are seeking to do here. Because you're creating this large amount of volume through institutional money, which is manipulating not in terms of, crowd cycles in terms of a normal price pattern. It's manipulating according to large volumes by certain parties at specific times, which has been happening historically for a long time. And if they get caught, they get caught. They pay a fine. Business goes on. Yep. What would you think of that?
I made a tweet about this recently, yesterday actually, talking about white collar crime. And someone replied to me. They said, look at Walmart, exactly. They bribed Brazilian officials and they had to pay $250 million. And the market celebrated because it was far less expected and way less than they made off of their scam.
Exactly.
Moral opportunities are a very big thing because it's always profitable. Yeah.
I mean, sometimes even these companies can book the tax in another country and book the cost in another country, as basically a tax asset in country too, depending on branches. People have been cheeky enough to do that in the past.
Yeah. You always hear the stories of, the so-and-so bank had to pay, $200 million for the fraud of taking $2 billion, and then they keep the $2 billion. They just pocket that.
Ooh. Yeah, exactly. I think HSBC only lost about 10% of what it made over laundering cartel money. Yeah. So it's not exactly a deterrent, when you think about it. Yeah. And this is exactly what's happening here. People are experimenting. It's less regulated. So what you're seeing now in terms of price pushes and swings and ups and downs and whatever, since the derivative markets came in last year, is, from what I can see, it's kind of a repeat of the 20s. In a lot of ways. And even when the legislation happened after that crash, it still didn't stop people doing business as usual because there are just fines involved. So in terms of, saying, what can we do to avoid this? Well, the short answer is you can't avoid it. You just have to be careful what you do, how you trade, how you analyze, how you look at the volume, how you look at the buy and sell. Yeah. Any news that might be in the pipeline. People have to be diligent and not just look at the candles. There's an awful lot more behind it. Because when you have large iceberg-sized whales maneuvering together in one direction, then the little guys are all going to get squashed. Yep. Which is what's always happened.
George Soros did mention last year that he was preparing to trade Bitcoin. I think that's one of those headlines that people talked about a lot at the time, and then it flashed. It was a flash, and then it fizzled out. Everyone forgot about it. Yeah, it was around the CME as well, which leads me to believe that this guy was shorting the hell out of it. It made him.
Wouldn't surprise me. It's not the first time.
Yeah, right.
It's not the first time. It won't be the last.
Yeah. So there's TA and there's wisdom of the markets and all of this, but the reality is Bitcoin is so small in terms of market cap. I mean, George Soros, even him by himself, he's crashed larger markets. Let's put it that way.
I don't think it's about massive gains, not on the scale they hope to make, because as you said, the market is too small compared to what they can make in others. This is about control. Yeah, this is about controlling the asset. It's not about the gains. The gains are secondary. The gains are the icing on the cake for these parties. This is about controlling the asset. Yeah, in terms of volume. The same way oil is priced in dollars. The petrodollar, rotation of money into treasuries, etc. It's not about controlling where the oil is. It's not about controlling the assets themselves. It's controlling about how much is released and at what price. It's controlling the money pump. Yeah?
Yep.
And it's controlling the growth as well. Which is the same way historically it's been done with oil. I mean, look what happened to Gaddafi when he went to the gold standard. Yeah, lesson in point.
So that's you bring up a good topic because we've been talking historically about the drops. What do you think this means for the future price growth of Bitcoin? Because I'm of the impression that in general it matters. ETFs and all these other derivatives matter less when it comes to Bitcoin. But obviously we can see the huge effect that CME has had. And I think Bakkt and CME and all these other institutional methods are going to continue to have this large effect. I mean, if you look at volumes even, there was that period where CME did more volume than BitMEX. And I'm not sure if that's still true, although I imagine it's probably still true. The markets are being controlled in terms of liquidity and volume by those institutional traders. The retail traders, all of the money that they have put together is not equivalent to the CME volume that happened in a year.
No, it's not.
Yeah.
And that will continue to be the case. You just have to be careful if what in terms of what you're doing. I mean, I tend to not trade leverage because I don't like being particularly ambushed by swings like that, regardless of what the pattern says.
Right.
You just have to be careful historically. This is about control. I mean, I have a kind of divergent opinion on KYC AML because I think that is a component of this. It's another method of control because if you think you go to a bank, you open a bank account, yeah?
Well, actually, I'm going to...
Social security number, ID, address,
stop you there, record. Negus, because we are actually at the end of the first episode, and it's a perfect time.
That bit next time.
Exactly. We can do the second episode and talk about KYC and AML. So we're at the 30-minute mark here. On that somber note, we're gonna have to sorry, we're not permabulls, but it pays to be realistic and it pays to pay attention to these kind of things. So let us know what you guys thought of this video. Leave your comments, retweets, tweet about us and all that. And we're going to do the second episode right now on KYC, and that one will release probably next week for the people listening. And we're going to keep up the discussion. See you guys next time.
Thank you. See you later.